This is Chapter 8, Video 1. Let's launch. Greetings and so welcome back. Okay, guys, a couple things before we go ahead and get started with this video is number one, I am shooting my new office and I hope that you guys really enjoy that. The second thing that I wanted to do is to kind of let you know in a little bit in advance, I've actually been fighting some really bad allergies. The doc wants to do some testing, and unfortunately one of the things I have to do is I have to stop taking allergy medicines that are going to last for about a week. And so you're going to be seeing me sniffling, you're going to see my eyes are like watering like crazy. No, I don't have COVID. No, I'm not sick. Don't worry about it. Everything's good to go. It's just that there's probably something that I'm becoming allergic to this year that I haven't been in the past, and so the doctors are working really hard to get that done. Now that that's over, so what I'd like to do is kind of talk to you about Chapter 8. So when we shot these initial videos way back in August of last year, this was just for a purely online course. It was an asynchronous course. There was no Chapter 8 being offered. There's no Chapter 12, never 14, 22, or 23, 24. And as a result of which, I never shot videos for those. Now, what I'm going to do in order to kind of help out, because I've had some students have actually really requested this, we're going to be shooting for Chapters 8 and 12, and then later on in the semester I'm going to be shooting for some of the other chapters as we get closer to those topics. And so before we begin, I'm going to go ahead and we'll kick it off to here. So today's learning objectives, we're going to be talking about regular tax liability computations. In the federal tax computations that we deal with is that, there's a few things that you have to understand in order to be able to come to that all-important number of how much we actually owe. And the first thing that you're going to deal with is filing status. Filing status determines a few things. Number one, it's going to determine your standard deduction. But second of all, it's also going to determine what tax rates you're actually going to use in order to calculate the tax for the individuals that are going to be affected by the tax. And so as a result of which, it's very important that we get this part correct. And there are certain qualifications that each person has. So on married filing joint status, the only way to qualify for the married filing joint status is that you have to be married as of the last day of the year in question. So that would all pretty much for everybody be December 31st of the year. Now there is one exception to that, and that's if one of the spouses dies during the year and they were married at the beginning of the year, then they would be considered married throughout the entire year. And we'll talk a little bit about that with the qualifying widower status. But I want to talk a little more about the married filing joint status because this is actually something that we deal with quite a bit when we're dealing with clients when they're trying to figure out, am I married or am I considered single? Do I have to do married filing separate or whatever kind of status that's going to be available to them? And generally speaking, what's going to make that determination is, number one, what's your status at the end of the year? But it's also going to make, there's also going to be a few other things that could put into play here. If I'm going to a lawyer and I say, say my wife and I decide that we're going to get divorced, something that we could do in order to better help our tax situations is file for a separation order as of a certain date. And then by doing that, what would allow us to happen is we could file separate tax returns. Even though legally we're still married, we're in a separated status. And as a result of that, you can go ahead and you can file at the single rate, the single status at that point. But the married filing joint status that we have, generally speaking, it's kind of like love. You're going to know if you're in it. Married filing joint's kind of the same thing. Even though it's a legal thing, there are some legal definitions that are in it. And you can't have one of those things, well, I don't want to be married to this person anymore, therefore I'm just no longer married. That's not how the IRS does this. And so as a result of that, that's usually what is your status as of the end of the year. Now, if you are a qualifying widower, what does that mean? It means, actually probably the best way to explain qualifying widower is to say this. To qualify for qualifying widower, what'll happen is that you're married and you have a kid, at least one kid, maybe two or three. And I think I've shared this in class. My mother died when I was 15 years old. And so when my mother died, I was 15. One of my sisters was 14, and the other one I think was still 12 at the time. I don't know if she had actually flipped over. She had not flipped over yet, so she was still 12. So what had happened is basically when my mother died, the year that she died, my father and my mother were considered married filing joint throughout the year. So once they got to the following year, because he had qualifying children, he qualified as a qualifying widower for the following 2 years. So it's the year after that she died, and then the year after that. And what does that grant you? Basically, what it does is it allows you to file married filing joint while still not being married. Now, if my father were to have remarried within that 2-year period, that qualifying widower status disappears and he goes married filing joint with the other spouse. And so that is actually something that's important, because one thing that I've heard from some people is, well, does that mean that he still gets to do married filing joint, qualifying widower, and then she files married filing joint? No, that's not how it is. Basically, once you remarry, the qualifying widower status terminates immediately if it's within the 2 years. That did happen in our case. My father actually stayed unmarried for many, many years after that, but has since remarried. But if he had married within those 2 years, he would have qualified for the qualifying widower status would have actually been expired. Now, the married filing separate. So a married filing separate is something that you can do if for some reason you think it's in their best interest. And there's a few times where that happens. I mean, before the Tax Cuts and Jobs Act, which actually just came into effect, there's actually a lot of times where we would basically just tell them, don't even do the math. We know it's not going to work out for you, because generally pre-TCJA, it wouldn't work out for you. Now, I've had a couple times where I've actually run the numbers on some clients, and we actually found out it was better for them to do married filing status since the TCJA. And so that generally is when you're going to want to do that. There's also going to be some other times we're required to do it. So if you file a non-resident tax return, 1040-NR, and you're married, you have to do married filing separate. You cannot do married filing joint unless you are from South Korea. South Korea, we actually have a tax treaty that says all non-residents can still file married filing joint if they have that. And then and so that's one of the benefits that South Korea has because of the tax treaty. There's also some other reasons why you might want them to do married filing separate. And I think I pointed this out in class. There's a legal reason why you might want to do it, and that's if you are questioning one of the spouse's legalization of their profession. And I remember when I was in tax class, they said, hey, yeah, if you know that the other person's a drug dealer. Well, they were kind of saying it facetiously, because if you know the other person's a drug dealer, you know that you're not going to have them as clients. You don't want clients that are going to be disreputable individuals. But one of the things that has actually come up lately is because at a federal level, marijuana is still illegal. But there are states where marijuana is considered a legal thing that you can sell for recreational use or medical use or whatever. Under federal law, you can't sell for any reason at all. So if you are worried about the federal government coming after one of the clients, so the married filing joint clients, you might recommend that they do married filing separate if you want to protect one over the other, because if they do a married filing separate status, what happens is when you do married filing joint, both partners sign the tax return, which basically means that both people are joint and severally liable for that tax return. If you want to protect the liability of one spouse versus another, you might recommend a married filing separate status in order to be able to protect your clients for that. But like I said, who knows? Maybe Congress within the next 1 to 2 years is going to go ahead and make it legal anyways. But it might be something that you're going to do if you really have a fear for your clients. I will tell you, here in Vienna or in Virginia, it's not legal, so this hasn't really hit us yet. But I've talked to some people in some of the other states where it's becoming legal, and there has been some talk about, hey, we wanted to do married filing separate to protect the other client. Now, the head of household status is basically where you are unmarried and you have a dependent. Now, that dependent can be a parent. It can also be a child. Now, how would you have a dependent that's a parent? Well, say for example, I'm in my upper 40s. If my father weren't married and enjoying his life in Washington State and he needed a place to stay, of course I would let him stay with me. I would be allowed to claim him as a dependent for the head of household status if I wanted to do that. Now, I'm married filing joint. Married filing joint is going to be better for me anyways, and in order to be head of household, you have to be single. That would only work if I was a single individual and I said, Dad, why don't you come live with me so I can better take care of you, okay? I do have a couple clients that do this because they have parents that they're taking care of, and while they still remain unmarried, still works out for them. And by the way, for the head of household status, when you're taking care of a parent, the parent does not actually have to live with you. So if the parent is in a nursing home or is in a home where they take care, where they live by themselves, but you're paying more than half of their support, you can qualify for the status of head of household in that sense. They do not have to necessarily live with you. And single is basically you're an unmarried individual by the end of the year. We do have progressive tax rates. We do follow the tax schedule. You can do the tax rate schedules. You can do tax tables. What will end up happening is that oftentimes your tax software will pick how they want to calculate the tax. Each one's different, and you can actually force it one way or the other in some tax programs. For the most part, as I recall, most of them are going to follow the tax tables because they're going to be able to look all that stuff up and everything. It doesn't hurt to take a look at it and make sure that it's right every now and then, but generally speaking, they're going to be within like a few dollars of each other, and it's not going to be worth it to really go too much further than that. So when we talk about the tax brackets, there's 7 tax brackets. You have the 10% bracket, the 12%, 22, 24, 32, 35, and 37. Now that's your marginal tax rates. And we talked about marginal tax rates when we talked about this back in chapter 1 and when we were talking about these different rates. And remember, marginal rates can be your decision rate. So if you're going to try to make a decision about whether you want to do something or not, the marginal rate is the way to go. Now, I kind of talked a little bit about the marriage penalty, marriage benefit. This is more of a political conversation. I'll be honest with you, this is my conference room where I would meet with my client. You can't see it because, and actually it's a good thing, it's kind of a mess because of all the all the camera equipment I had to set up. I've never sat in a conference room with a client and talked to them about marriage penalty versus marriage benefit. It's just not something that we normally do. Usually you pay taxes as they're required to. I mean, from a political perspective, this does get brought up quite a bit because there has been a marriage penalty for many years. There continues to be a marriage penalty, mostly because of the state and local tax deduction, where they did not say, look, if you're married filing joint, you could do $10,000 each, and then if you're single, you do $10,000 by yourself. Instead, what they've really kind of gone and done is they've said, look, you know, if you're married filing joint, $10,000. If you're single, $10,000. So in that case, being separated would actually yield you a better tax event. Now, again, I've never said, you know, I had one client who came to me and said, you know, my wife and I have been together for years. We're kind of doing some planning, and we decided it might be in our best interest to cohabitate and just get a divorce. And I'm kind of like, look, guys, no. I mean, I can't in good conscience recommend. I mean, yeah, from a tax perspective, it might make some sense. But no, I mean, you know, my personal opinion, and this is kind of where it gets to, sometimes we do things for clients because of legal reasons, and then sometimes we do things for non-legal reasons. You know, and I don't mean illegal reasons, but non-legal reasons. You know, stay married because that's what you want to do. Now, if you want to have one of those, you know, marriages where you say, okay, well, legally we're divorced, but we went before a priest, and, you know, and eyes before God, we're married. You know, that's to each his own. You know, to be honest, though, I've only had one time where this ever came up, and other times when it does come up, it's usually said in a joke. We don't normally talk about it, but I do know that the news likes to talk about marriage penalties quite a bit because they're trying to affect public policy. And again, that kind of gets back to what we said in the original class, where you need to focus on, you know, be careful about what the you know, what they're saying about in the political realm. All right, so the federal income tax computation, again, you know, exceptions to the basic tax computation. So you're going to run all income through that ordinary income rate unless you have capital gains or you have dividends, and then those are going to be taxed at the preferential rates. The preferential rates being 0, 15, or 20. Now, some of you might say, well, which rates do I use? And the answer is, well, first of all, if you're doing your tax returns on a tax software, don't worry about it, they'll do it for you. But you would basically, what happens is that if you are in the 10 and 12% tax bracket, you're going to use the 0% rate for capital gains. If you are in the 37% tax bracket, you're going to use 20% for the capital gains, and anywhere else is 15. And normally, in a classroom, I draw this up on a board. I don't have my whiteboard set up yet here, so unfortunately, we're not doing that. That applies both to capital gains and dividends. Now, if you have, I've had this question once or twice in class. I just want to make sure that I clarify it. If you have capital losses, does that mean you can still take dividends at capital gains rates? And the answer is yes. It's completely separate. Capital losses, capital gains are factored in completely separate from the dividends. So if you have capital losses and you have dividends, no, you're not going to net them out together and do that. That would be ridiculous. But I have had a couple of people ask me in the past, just for clarification's sake, and I want to make sure that I kind of hit that. So it is, and it says here in the bullet points, and I'm looking down because it's actually just below us. The two different rates on one gain is entirely possible. Now you might say, how is that possible? Well, so for example, say that the 12% rate ends at $75,000, and I'm just making that up because I don't have the table in front of me. Again, that's not something I would memorize because it changes every year. If it ended at $75,000, and say I had $60,000 of income, and I have $30,000 of dividend income. So from 60 to 75 would be at 0%, and then 75 for the remainder of the 15. The 15 was taxed at 0, and the other 15 would be taxed at 15%, and that's kind of how that would end up working out. So you could have that happen. Another thing that I've seen in the past, where you've got high net worth individuals, maybe a lot of their income is in the dividends range, and so what ends up happening is they've got a lot of, maybe that's all they have is dividend income. And so they've got a whole bunch that's at 0, they got a whole bunch that's at 15, and then they may have some that's at 20 if they have that much dividend income. Generally speaking, when you have high net worth individuals like that, they're going to have income from different sources, and that's not going to be the case. It's going to be very unusual that they would come strictly from dividends. All right, so this is going to be the kiddie tax. I told you guys don't worry too much about this. We don't encounter this too often. It is something you do need to know, just because it can happen. If you have a person who has children who have unearned income greater than $2,200, they will fall under the kiddie tax. Now, a quick remedy to that is basically just take the income, throw it on down mom and dad's tax return. It's over with. So we've actually done that in the past just to kind of simplify things. Once we know they're going to be in the kiddie tax rate, mom and dad usually know what's going to happen with this, and they say, look, just throw it on our tax returns, we'll go ahead and we'll take it. And the way we do it with the kids is that because sometimes it'll be on the kid's social security number, we report on the kid's tax return, then we back it out and say report it on parent's tax return, and that's how we get that filed. That way it will not generate a CP2000 notice, because the CP2000 notice doesn't, and I don't mean this as a joke. I know I make fun of the IRS periodically, but they don't use artificial intelligence. They're kind of doing a binary. Is it there or isn't it there? Okay, so if the kid's tax form says his social security number or her social security number on their name, and the tax form that they filed doesn't have that number on there, CP2000 will send a notice, even though you might have taken it and thrown it on mom and dad's return. So you still need to file a kid's tax return, claim the income on Schedule B, and then on what used to be line 21, we probably wouldn't do it on line 21. We would actually do it on something else. We would just say it's a negative number that we throw on it, or you could put it as a negative number on Schedule B too. I've seen it done both ways. In fact, with dividends, it's probably better to do that. Most of the time that I've actually seen this, it's actually been interest income, because interest income is kind of what they're trying to shift away from them. That's where you kind of want to, if you have, the interest income, it's very easy. You can put it on Schedule B and then do a negative other income number, because interest is going to be at ordinary rates. That's kind of usually what we've ended up doing. We don't like filling out kiddie tax forms. It's a pain in the you know what, and it's much easier to just go ahead and throw it on mom and dad's and then call her done. Again, they're going to say it applies to the kids under 18 at the year end. Is 18 but earned income not greater than half the child's support. Then you also have child is over 18 but under 24 and is a full-time student and unearned income is not greater than half the child's support excluding scholarships. Again, by the time we get to $2,200, we just go ahead and throw it on mom and dad's return. We don't even think about it at this point. That's usually how a lot of them end up taking it. The last tax we're going to talk about is the NIIT tax. So NIIT stands for Net Investment Income Tax. NIIT was actually put into effect as part of the Affordable Care Act. There was actually 2 taxes that got put in there. We don't talk about the additional Medicare tax. Usually with the additional Medicare tax, it has a little bit of an effect on the return, but not a whole lot. And most of the time it's going to be automatic calculation anyway, so I don't really talk too much about it. NIIT, though, I think is important because, first of all, it's a lot more substantial. Instead of 0.9%, you're talking 3.8%. So if you have capital gains rates at 20% because a person has very high income, their capital gains rate really isn't 20%. It's 23.8% because you've got to factor in NIIT. That's important, and you want to make sure that you're taking that into consideration. Again, if you have net investment income from interest, dividends, annuities, royalties, rent, passive income, net gains, disposition of property, less related allowances or deductions. One thing I did mention in class, and this is true, this will affect you if you sell your house and your house goes above the $500,000 exclusion that we will mention in Chapter 14. Again, you want to make sure that you are kind of following with this because it can actually cause your clients a little bit of grief. Quick story, I actually had a client from Russia who was selling a piece of land, and the good news was we were able to get foreign tax credit. They paid like 30% tax in Russia. They were going to pay 15 or 20% here in the United States. Because it was 30% in Russia, 20% here in the United States, it was going to wipe out their entire income tax. Foreign tax credit had no effect on the NIIT. They still owed money to NIIT because of this. Okay, so that's all I really have to say about this class today. Guys, it's good to see you guys up and about, and I hope that you guys really enjoy these videos. If you have a chance to, and you have any questions, go ahead and feel free to reach out to me. I'll try to get back to you as soon as I can. Thank you very much for watching this video, and I will see you guys in class.